Amazon's physical footprint is staggering. Across the globe, millions of servers run quietly, processing the infrastructure of the modern internet. As of May 2026, the market values this operation at nearly $3 trillion. Amazon Web Services is growing at 28% year-over-year, and corporate operating margins have hit an all-time high. But beneath those top-line numbers lies a stark financial reality. Amazon's free cash flow, the actual cash left over after running the business, has virtually disappeared. This dual-axis chart tracks 8 quarters. Operating income climbs to $23.9 billion, but trailing 12-month free cash flow collapses from $26 billion down to $1.2 billion. Management guided $200 billion in Capex for AI infrastructure, devouring that cash. This creates a duration mismatch for anyone holding the stock today. You're sacrificing immediate cash generation to fund a multi-year hardware build-out, betting entirely on AI dominance years down the road. Wall Street consensus looks at this cash burn as a necessary step to capture an AI infrastructure supercycle. They argue the massive spend secures future market share. Contrarian analysts look at the exact same data, the zeroed-out cash flow paired with premium valuation multiples, and see a vulnerable narrative bubble. CEO Andy Jassy and his leadership team are taking on this hardware risk to deploy custom silicon, aiming for a near monopoly on future compute power. We need to check the math behind these arguments. We must determine if Amazon's expanding cloud moat justifies the $3 trillion price tag, or if the required growth is mathematically out of reach. An investment in Amazon today is effectively a bet on the timeline and scale of enterprise AI monetization. Amazon Web Services forms the baseline of the current valuation. In the first quarter, AWS generated $37.6 billion in revenue, growing at 28% year-over-year. The main bottleneck in the AI industry is no longer software development. As this data center view suggests, the limiting factors are physical, hard compute availability, and the electrical power infrastructure to run it. Amazon is solving this hardware bottleneck internally by deploying their own vertically integrated custom silicon, specifically their Trainium and Graviton chips. Controlling the chip architecture reduces Amazon's reliance on premium-priced NVIDIA hardware. That cost advantage flows to the bottom line, driving AWS operating margins to a record 37.7%. But there is a distinct trade-off. Fabricating custom silicon requires immense upfront capital and leaves Amazon holding significant hardware risk if enterprise clients suddenly demand a different AI architecture. Amazon is trading today's cash flow for hardware independence, building an infrastructural moat that competitors cannot easily or cheaply replicate. To see if customers are buying into this infrastructure, we look at remaining performance obligations, the metric for locked-in, contracted enterprise demand. This chart quantifies Amazon's contracted future revenue. The AWS backlog stands at $364 billion, showing rapid quarter-over-quarter expansion. Amazon secures this demand through multi-year, multi-gigawatt power and compute commitments. These are take-or-pay contracts, making the revenue highly predictable. The downside of these massive contracts is that they eliminate financial flexibility for the client. If those enterprise customers fail to see a return on their own AI deployments, it could trigger a corporate budget-slashing cycle. The backlog guarantees revenue in the medium term, but it ties Amazon's ultimate fate to the actual performance of their clients' AI initiatives. Knowing the revenue is contracted, we have to look at what you pay for it today. Amazon currently trades at a premium of roughly 33 times forward earnings. This table places that multiple in context. Compared to Microsoft at 31.8, Google at 29, and Meta at 21, Amazon is priced at the very top. Paying this premium grants exposure to dominant operations, but leaves virtually no margin of safety. A reverse discounted cash flow model decodes what performance the market expects today. To justify a $3 trillion valuation while burning $200 billion in Capex, Amazon must sustain over 15% annual revenue growth and reach massive future cash flow margins. This mathematical setup is sensitive. If AWS growth decelerates even slightly and drops below 18%, the equation breaks. That scenario could trigger a 30 to 40% drawdown in the stock price. At $274 a share, you are paying for absolute perfection. Any execution delay will compress the valuation multiple quickly. The financial data leads to specific decisions. The right move depends on your portfolio constraints. This quadrant chart maps risk tolerance against your time horizon, creating zones for holding, waiting, or selling. If you already hold the stock and have a 3 to 5 year horizon, the data supports a hold. You have to endure sideways volatility while the capital expenditures convert to revenue. If you have cash and want to build a position, look for a technical pullback to the $230 to $250 range to secure a margin of safety against multiple compression. If you rely on free cash flow yield or you fear a macroeconomic drawdown, the move is to avoid or sell, shielding your portfolio from the $200 billion execution risk. Your next portfolio action is dictated by your capacity to absorb near-term cash burn in exchange for long-term AI market dominance. The defining trade-off for Amazon in 2026 is unavoidable. Management is zeroing out cash flow today to construct an integrated monopoly on AI compute tomorrow. They are executing a massive infrastructural gamble at a scale that few other companies could attempt. The current valuation reflects record operating margins and $364 billion in contracted demand, but those figures are balanced against demanding growth requirements. In investing, trade-offs are the only truth. Buy the specific numbers that align with your strategy rather than the surrounding narrative. In a market influenced by AI optimism, discipline and patience are the only reliable mechanisms to protect your capital.